Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning. Here we go with a brand new week. This is Peter Lewis welcoming you to Money Talk for Monday, the 8th of January, 2024. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Chinese shadow banking giant Zhongxi Enterprise Group has filed for bankruptcy in one of China's biggest ever corporate failures. A Beijing court on Friday accepted the investment group's application for bankruptcy and liquidation, and the court said that ZEG's assets are insufficient to pay off all debts, and it clearly lacks the ability to repay in full. China is launching an anti-dumping investigation into liquor products like brandy from the European Union, escalating a trade spat between Beijing and Brussels. The move comes after the bloc opened a probe last autumn into China's electric vehicle subsidies. Officials at China's Commerce Ministry said its anti-dumping probe into brandy imported from the European Union followed complaints from the domestic brandy industry. US job growth picked up in December and wage gains exceeded expectations. Employers added 216,000 jobs and the unemployment rate was unchanged at 3.7%. The non-farm payrolls number was up from a downwardly revised figure of 173,000 in November. Pay shows signs of rising, with average hourly earnings in December up 0.4% on the month and 4.1% from a year earlier. Hong Kong may take a year or two longer than expected to return to budget surplus, Financial Secretary Paul Chan said on Saturday. He attributed the delay to a sluggish city economy and reduced land sales hampering government income. He didn't give a new deficit projection, but said that government coffers were estimated at about 720 billion Hong Kong dollars by the end of 2023-24, more than $110 billion lower than the year before. He also warned of increasing corporate tax and government service fees to boost income. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Michelle Lam, Greater China Economist at Societe Generale Corporate and Investment Banking. Providing a view from Mainland China will be Shanghai-based independent economist Andy Scher. If you have any questions or comments, please go to my website, peterlewismoneytalk.substack.com. I'm also on Facebook, where my page is Peter Lewis Money Talk.
Peter Lewis's Money Talk.
On Wall Street, the S&P 500 ended Friday modestly higher, but all three of the major averages snapped a 9-week winning streak following a stronger than expected jobs report. The S&P 500 index rose 0.2% to end at 4,697. The Dow ticked higher by 26 points, or 0.1%, settling at 37,466. The Nasdaq Composite added 0.1% to finish at 14,524. The three major averages notched their first negative week in 10, with the Nasdaq suffering the biggest decline at 3.2%. The S&P 500 dropped 1.5% over the week. The Dow was the outperformer, dropping 0.6% over the 5 sessions. US Treasuries rebounded Friday after fresh data showed that the country's services sector slowed significantly in December, boosting hopes that the Fed could soon start cutting interest rates. Benchmark 10-year Treasury yields closed the week at 4.05%. The dollars rallied to start the year, and it saw a volatile day Friday in line with treasuries before ending the day flat. For the week, the dollar index was 1% higher. The yen was unchanged on the day at 144.65, but saw a weekly decline of 2.5% as US yields climbed. The Chinese yuan managed to halt declines versus the dollar, with onshore yuan back down around 7.14 renminbi compared to a weekly peak of 7.18. Spot gold prices were flat on Friday, trading at $2,045 a troy ounce, but remain 0.8% lower than the previous Friday's close. That's its first decline in 4 weeks. Brent crude oil settled at $78.76 a barrel, rising 2.2% for the week. And in Hong Kong, the Hang Seng fell 111 points, or 0.7%, to close at 16,535 on Friday. And the decline was the steepest for the first week of trading since 2005. On the mainland, the Shanghai Composite fell 0.9% to close at 2,929, with the benchmark down 1.5% over the week. That's its sharpest weekly fall in at least a month. And looks like the Hang Seng is going to open about 50 points higher. That's about 0.33% this morning. Futures markets projecting an open of 16,589. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
To welcome our Monday morning guest, we have with us Alex Wong, Director at Alex K.Y. Wong Asset Management. Happy New Year, Alex.
Happy New Year.
And thank you. And also with us is Michelle Lam, who is Greater China Economist at Societe Generale Corporate and Investment Banking. Happy New Year to you, Michelle.
Yeah, Happy New Year, Peter.
Thank you very much. Chinese shadow banking giant Zhongxi Enterprise Group has filed for bankruptcy in one of China's biggest ever corporate failures. A Beijing court on Friday accepted the investment group's application for bankruptcy and liquidation, and the court said ZEG's assets are insufficient to pay off all debts, which are estimated at about net debts estimated at about $38 billion. Alex, why is Beijing prepared to let this company fail when it's at the heart of the shadow banking system? And a lot of individual investors here on the mainland are going to lose a lot of money, aren't they?
Well, I think they took the stance that they don't want to do a massive payout. I think they already let many property high-yield bond fail, and many actually property developers fail as well. So I think the policies is that they let the investors bear their own mistakes and not giving massive payout like what we have seen in 2008 in the US. I think this is the policy that the Chinese government is doing.
It's risky, isn't it? Because it could go wrong, and there could be some real disruption from this, and also some very unhappy investors.
Yeah, of course. So that's why we are seeing money coming out from China. So there's the risk that people are not willing to take risk or pay, or they need to get a very high risk premium to invest in China. So we are seeing a general derating of Chinese assets right now, and that is a bit risky because it is not easy to refinance the debt, and also not easy to issue equities as well. So the whole engine of the economy actually could be quite bad.
Michelle, this is coming, of course, on top of the property slump. We've got weak domestic demand. We've got sluggish trade, all weighing on the economy, and also, obviously, the stock market on the mainland down 3 years in a row now. Is this going to have an impact on consumer and investment sentiment on the mainland?
Well, to some extent, I think markets sort of expect that Zhongxi is going to fail, given that the news already showed up last year. But I think it's probably slightly surprising that they got liquidated so quickly, because if you look at the big developers like others, they haven't really got into a proper liquidation procedure. So I think that really shows the difference of the policymaker treating the shadow banking companies related to real estate versus the developers quite differently, which means that for the people who invested in these like property assets, etc., it's quite likely that they're not going to receive a bail, as Alex suggested. But for the developers, they still have a lot of unfinished projects to complete, and I think these really matters for social stability, and that's why the government has been stepping in to provide a lot of funds for these developers to finish the projects. And I think that is really the difference, that I think that right now the policymakers are still going to provide funding support to some of the developers to make sure that the unfinished projects will get delivered. And regarding to the point of whether what's the implication for this failure, I think of course it's going to be the negative for consumer confidence for those people who have invested in the property assets. But I think people already prepare for it since the beginning of the property crisis. So maybe the additional extra impact to the confidence is going to be minimal.
I mean, Alex, this is also presumably not going to do much to restore confidence in the minds of foreign investors. As you mentioned earlier, they've already been bailing out of Chinese equities. Seeing things like this presumably is not going to help them come back into the markets.
Of course, we are not seeing them to come back soon. And actually, if you look at the consumer sectors in Hong Kong, I mean the consumption stocks in Hong Kong, they are getting another round of derating. last Friday we got very encouraging data from Enter, but the stock just failed to go up and then actually close down. So that means people are still liquidating even the best assets in Hong Kong. So I think this round of derating actually would still be going on. And the point is this kind of derating actually is very risky because if your P ratio go down by 2 or 3 points, then the stock actually will still have 10 to 20% downside. So I think people do not feel comfortable in investing in those new economy stocks in Hong Kong and also the consumption stock in Hong Kong. So that could still drive the market lower.
And this is also affecting consumption stocks elsewhere as well around the world, isn't it?
Yeah, because people are discounting that the Chinese actually would spend less. And I think also the rise of brandless trend, like products offered by Costco, Uniqlo, I think are affecting the overall spending patterns of the world as well. So so that's why I think we are seeing a run of derating in brands in global market as well.
And what do you make of this latest news about China targeting liquor producers, which several people think is going to be retaliation for the EU's investigation into EV sort of subsidies? This obviously affects French liquor makers in particular because they're some of the biggest producers of brandy. But presumably this also is another sort of nail in the coffin for consumer sentiment.
Yeah, right. I think that could be, because that would hurt the sentiment in other parts of the world. I mean, those companies are doing business with China, so it would hurt the overall consumption sentiment. And I think eventually, probably people would hope for some kind of a deal would be coming out. And the sentiment towards the EV sectors in China actually will not be affected much. Right now, the exports actually accounted for a very small percentage only. And I think people are looking for other markets, not EU, but probably Middle East and Russia for the exports. So I think that will not affect much on the EU stocks in Hong Kong.
Michelle, for the economy overall on the mainland, are you seeing any signs of a turnaround this year from the data that we've seen recently, particularly the PMI data?
If you look at the latest services PMI, it seems to suggest that the things are doing a little bit better compared to manufacturing. I think it's also to do with a seasonal factor, which is we go to around the turn of the year, which the people taking holidays to travel around the country, and there have also been some opening up in terms of the visa restrictions, so that probably also helps too. But I think if you look at the manufacturing PMI, quite interestingly, the official one was actually falling recently, but the China one seems to be doing better. So I think overall, it's still a pretty mixed bag in terms of the manufacturing sector. And I think going to the first quarter of this year, probably things should start to look a bit better because we are seeing that the policymakers are starting to inject money into the economy. I think most visibly via the PSL lending by the PBOC recently. So quite clearly, they are really doing something about it. And I think in terms of the data, we're going to see it as in the pickup in the infrastructure investments, and probably the decline in the property investments will also be easing a little bit as well. But I think if you talk about the major weakness in the economy, which is the consumption, it is still going to be affected very seriously because of the property price correction. And unfortunately, if you want to monitor the property situation in China, it's actually not that easy, right? If you look at the prices, the official data tends to understate the decline of the correction. So I think based on anecdotal evidence, people are actually talking about maybe 20 to 30% of decline in the top tier cities. And it seems that the situation has got worse towards the end of last year. So I think it's the policymakers failed to announce policy to really revive the confidence in the property sector. And we're looking for a slow burn, the correction in the property sector. And I think that's going to be very bad about consumption.
Well, what do you think, Alex? Do you have any optimism that maybe we're going to see a turnaround this year?
No, I don't think we will see a turnaround easily. I think this is just a repeat of the Japan situation. So we probably will see the downturn to last years, I think.
There is a difference, though, isn't there, between what happened in Japan, in that China is focusing on certain industries that it really wants to boost, like electric vehicles, batteries, solar panels, putting a lot of effort, a lot of money into them to really try and boost those sectors, put extra investment into those sectors, and also obviously export those goods overseas. Is that going to be enough?
I think that it's still that the problem will still exist because the other parts of the world actually are not that friendly to Chinese products right now, and you probably got only several allies like Russia, Middle East. I think that probably would be your growth point. Even India are not that friendly as well. So I think that the risk is that the export market is not that easy to explore right now for Chinese goods, not like we are seeing decades ago. And then I think that the property bubbles actually are still a very major factors in the local consumption. So it's not easy to get back to normal, I think, for China, because right now investor sentiments around the world towards Chinese action actually is super weak, and I don't think we would see a resumption of appetite soon. So this is where like the downturn will continue for years. I think even though it's not like Japan, probably we are see some sectors getting boosted by policies, and there are some still monies are inflow into some sectors, but I don't think the overall situation will improve.
Michelle, President Xi Jinping uses this phrase a lot now, high quality development. He said it in his New Year's address when he outlined the country's goals for this year. He said it on at least 128 occasions last year. What exactly does he mean by that? When he says he wants to pursue high quality development, what exactly does he want to do?
Well, I think this phrase is nothing new. Indeed, I think even going back to maybe 5 years ago, China has always been trying to de-emphasize the pace, the quantity of growth, and switching the priority to the quality. And remember that some analysts actually were predicting that maybe the Chinese government is going to abandon announcing the GDP targets. And they've been announcing all sorts of plans to boost the new infrastructure investments, which are including the like 5G, like Industry of Things, AI, and these things are really like related to the quality. But I mean, like, well, he talked a lot about like quality of development, but the thing is, it's not that easy. It's not just simply just like talking about it. I do think China has the advantage of mobilizing funds very easily by the government to these ideal sectors that they want to push. But I think, well, whether they're going to succeed, I think it really depends. But I think even if they succeed, I think it could create a situation of oversupply, which I think if you look at the renewable energy sectors, the battery sectors, it really, for example, the renewable energy sectors, the stocks have not been doing great last year because there is a lot of concern about the oversupplied or along the supply chain. And this is why they are now trying to export these products to the rest of the world, because China is good at producing it, but it is not very good at stimulating the demand in domestic country in China itself. So that's why they need to export these capacities to the rest of the world. And I think probably to some extent, I think it's a situation that's going to take place for some time. Then probably we don't have to worry so much about the world talking about structurally high inflation, because China is still a country that is going to export deflation to the rest of the world to offset this factor. But in terms of whether China could get out of this Japanification, I guess it probably won't take 20 years. I think China has not really been experiencing a property correction for forever, and I think a couple of years of correction doesn't hurt. It's just what other countries also will go through. Typically, when you look at the U.S., Spain, South Korea, Hong Kong, these countries also take a few years to come back. But I mean, whether it's going to be a loss, 10 decades, 20 decades, I think there's still a lot of policymakers, the things that they can do to revive confidence over a few years. It's not going to happen just over a couple of months, but we just need to look at it from a longer term perspective.
But the problem is this oversupply that China is producing. There's very little willingness in the rest of the world, particularly in the US and the EU, to absorb that and to keep on having these huge trade deficits with China.
Yes, that's why we're exploring new export partners from the Belt and Road and from the Middle East.
Alex, let me ask you about Hong Kong. Paul Chan was talking about the budget deficits over the weekend. There seems to be some concern that the budget deficit is getting out of control here. And he was talking about maybe raising taxes, corporate taxes, other government fees. Is this starting to become a problem and something that we need to focus on this year?
Yeah, I think, of course, this budget deficit would last several years right now, because the problem is that we have been relying too much on land sales. And I think this is very obvious that it's very difficult to get land being sold. So I think that's why the major revenue in Hong Kong actually is being gone right now. And then other parts, I think we are seeing contractions of business activities as well. So that's why we are very likely to see the budget to remain in deficit. But the good point is we do get some strong demands for debt. So probably the government is still okay to go to issue debt. Recently, we have a very strong reception to the airport authority bonds. I think that's probably we would see Hong Kong to use some more debt financing in the next few years.
A lot depends, of course, on what they do with this debt, doesn't it? If they just raise more debt to give out more sweeteners in the next budget and consumption vouchers, that's not going to be much use. If they invest it in good long-term projects, then maybe it will be a different thing. But our budgets tend to be very dependent upon these short-term sweeteners.
Yeah, I think that they will not give out consumer vouchers, but the problem is that even the normal operating expenses of the government is quite huge. So I think the problem right now, we probably may not see the government spend money easily, but I think even if they are prudent in spending, the normal budget actually is still too high.
Michelle, how do you see Hong Kong's fiscal situation looking at the moment? Is it starting to look a little bit more precarious to you?
It is, but I think I've talked about this before, which is that a lot of countries actually have fiscal debt. So Hong Kong is in a very special situation that it always has like a lot of fiscal surplus to use. But the thing is, I just don't really understand why people are so worried about raising debt. But I think to some extent, I think it's also right for the government to worry about that the major fiscal revenue is going to be under pressure, maybe on a structural basis. So I think in the news articles, he also warned of increasing the corporate tax and government service fees to boost income. I think it is something that presumably I think the government is thinking about, like what's the best way to really find a new source of fiscal revenue that could be really reverting the situation. And I'm afraid that could be even undermining Hong Kong's competitiveness even more, because Hong Kong has always been competing itself compared to other economies like Singapore, for example, in terms of the low tax regime. But even if that advantage is also lost, then I'm not sure what's the kind of attractiveness it is that Hong Kong has to international investors on this. So that is a bit concerning.
Okay. Now, US jobs growth, that picked up in December. Wage gains exceeded expectations as well. Employers added 216,000 jobs. The unemployment rate unchanged at 3.7%. Non-farm payrolls was up from a downwardly revised figure of 173,000 in November. Alex, at first sight, the headline number here looked quite good, but when you start digging into these numbers, wasn't so pretty, was it? Because there were some rather worrying things here, like the decline in the participation rates. The number of people in employment dropped quite sharply. What did you make of this data?
I think eventually we will see some slowdown. But of course, the job market is still quite resilient. I think the market actually would expect the U.S. economy to slow down a bit into this year. So that is in line with the expectation. The real key would be inflation, I think, because the point is people are expecting rate cuts this year, and they expect a very aggressive rate cut. So I think the focus should be on inflation instead of the job market. The job market actually should be okay, not too bad. And then I think if inflation's come down and then we are seeing some signs of weakness, probably the Fed would start to cut rate. So I think that is the market consensus right now. So I think the focus really is on inflation instead of the job market. The job market actually had been resilient and expected for quite some time.
Do you think inflation in the US is going to come down further this year?
I think so. I think, as the Mr. pointed out, I think that China would be going to export some deflation in the world to the world, and then I think the overall commodity market actually are coming down, and PPI actually had been always weak. So I think we are going to see CPI to come down finally. So I think that this year probably the inflation will come down.
Michelle, it hasn't panned out really, has it, in the US, how many economists, many macro strategists thought at the beginning of the year. They were saying that interest rates were going up so sharply that indebted businesses would fail quite quickly, consumers would draw in their horns, recession would come along. Hasn't really turned out that way. But what about for this year? Do you think maybe there's a delayed reaction to all these interest rate hikes?
Yeah, many people have got it wrong. But for this year, I think it's finally the time of reckoning, which means we're probably going to see some slowdown in the US. And my bank's US economist is expecting a shallow recession around the middle of this year. But in terms of the Fed policy rate, even though we're not going to have a notable slowdown, I agree with what Alex mentioned, which is the people are now focusing on the CPI. So as long as the CPI is coming down, then the Fed is feeling more comfortable to cut rates. And especially this is going to be an election year. So I think the Fed policy is going to be on the easier side most likely. But I think in terms of whether it's going to cut rates as like 150 basis points that the markets were pricing in previously, I think people are probably too optimistic about this.
Alex, what do you make of the market reaction? We're now seeing the beginning of this year, global stocks and bonds in their worst start to a year since 2003. And that's sort of almost the complete opposite of what we were seeing at the end of last year, where we were having the best sort of period for many, many years for global stocks and bond markets. How do you explain these extreme swings in sentiment that we're seeing at the moment?
I think, first of all, we are in an extremely overbought situation going into this year. So we are seeing some kind of correction. And then we got a downgrade on Apple that is also hurting sentiment. I think the correction magnitude actually is not too worrying in the US right now. We are seeing some stabilization on last Friday. But I think the theme actually would be diversification. This year, probably, the Magnificent Seven may not be that strong. I think the people actually may like to pick up other laggards or value in other parts of the market. So overall, I think this is just a correction of the strong rally last year. And then we are seeing some kind of consolidation. Not too bad. I think people probably would still expect rate cuts and seeing some values among other sectors. But I think the strategy is not to focus on the Magnificent Sevens. I think Apple weakness actually is a concern. And then probably I think Microsoft, NVIDIA probably would be the leader in the AI theme. They would still be okay, but other big cap, mega cap, I think may not be may not repeat the miracle last year.
Do you think, Michelle, people are getting too carried away with short-term sort of moves and trying to guess what the Fed is going to do at the next meeting and whether the next piece of inflation data is going to be up or down? The fact of the matter is, long-term, inflation's going to be higher than what we've been used to, isn't it, over the past few years? And interest rates are going to certainly be higher than what we've been used to. So regardless of what happens in the short term, medium to long term, this sort of like free lunch that we've had for the past few years is over.
I think based on the investors' experience last year, I think it is still good to position yourself with some to be nimble, to not to be too overconfident in your positions, because the Fed, the swings the market swings could go either directions very quickly. So I think in terms of the probability of direction of Fed policy traveling, people are more confident. But I think in terms of the structural factors, people are it's still good to be cautious. Yeah.
And Alex, finally, let me ask you about Hong Kong. We're now in the worst start to the year since 2005. At the end of the last year, people were thinking, surely it can't get any worse. It has.
Yeah, I think Hong Kong is still experiencing a very severe derating. As I've said, the consumption sector actually is very worrying. And then we could still see another 10 to 20% downside if we see some more derating. I think it's not about earnings; it's about the valuation. I think even at this level, people are not feeling comfortable, because if you look at Meituan, actually, if you may feel it is cheap around 100, but it come down to below 80 in just 2 months. So I think people view Hong Kong as still a very risky place to bet. So and for the old economy side, actually, they are affected by the property market downturn. So those stocks like HSBC, China Telecom sector, and some resources are being okay. So I think it would continue be like that. So we may see the market to go down further, but the index may not reflect that because of the strength in several blue chips. But the overall sentiment actually is quite bad, and this is not being indicated by the index. So I think it is still a little risky in certain sectors in Hong Kong right now.
If you wanted to put your neck on the block, do you think the Hang Seng is going to be higher or lower by the end of this year?
I think it's still going lower because the valuation actually is very severe. I think it is very likely to drag down the whole overall market eventually. So I think Hong Kong is going down this year.
Okay, well, thank you very much for your thoughts. Have a great week ahead. You heard there Alex Wong, who is director of Alex K.Y. Wong Asset Management, Michelle Lam, who is Greater China Economist at Societe Generale Corporate and Investment Banking.
Money Talk.
I'm joined now by Andy Sher, who is a Shanghai-based independent economist. Morning, Andy, and Happy New Year.
Good morning, Peter. Happy New Year, too.
Let me ask you, first of all, about the news over the weekend, the bankruptcy of Zhongji Enterprise Group, which is at the heart of the shadow banking system. A lot of individual investors, mainly rich ones, of course, are going to lose a lot of money there. Why is Beijing prepared to let this company fail?
I think it's a shadow bank. And it involves individual money from individuals, and I don't think the government would ever pay out something like that. So I think the shadow banking system, the banking regulator said at the beginning of last year, 29 trillion, high risk, basically toxic. So I assume all their money will be lost. So this is one of those. I think it's about 3.2 trillion RMB. So it's a small part of the overall problem.
But there are others, of course, aren't there, as well, in the shadow banking sector who presumably have the same problems. Does this have any sort of economic impact in terms of maybe impact on consumer sentiment and people's propensity to go out and spend? Is there any economic fallout from this?
Well, China is, it's going in two different ways. One is that the blue-collar workers have a lot of bargaining power because of labor shortage. Their salaries continue to rise. So I think the basic consumption is still okay. But in terms of like the high, the wealthy people, they are losing money in the shadow banking system, obviously, and the stock market is not doing well. The property market is going down. The land basically is not liquid anymore. So I think that the demand for luxury stuff, like let's say Ferrari or like Hermes bags, that kind of thing is really deflating.
I mean, the trust industry in China is obviously a key alternative funding source for some of those weaker borrowers who can't get regular bank loans, such as developers, some local government financing vehicles. Does this have an impact on them if we start to see, particularly if these problems widen across the shadow banking sector in China?
Shadow banking system hasn't been lending for a while. So I think that this is the reason why a lot of local governments are distressed because they don't get money from property developers anymore. So it's been going on for over a year. But but in terms, what's going on now is that how the losses are being realized. Okay, and I always believe that the government would not bail out the shadow banking system. They let it grow precisely for an outcome like that. They tighten up the lending criteria for the state-owned banks. Then the shadow banking system rose about a decade ago, and it happened for a reason. So that's why now what's going on now is logical.
Do you think Beijing, President Xi Jinping, can keep their nerve? Because this could lead to some economic turmoil, couldn't it? Are they going to stick with their resolve of not providing money to, shadow banking lenders, to property developers? Can they do that?
No, absolutely not. They will let the shadow banks all die.
They will?
That I believe.
Okay.
Yeah, they will. Yeah, because the economy is... including all these shadow banks in Hong Kong, much of the Hong Kong banking system, financial system, all these guys in Central are really shadow bankers. They're bust, but just they don't know. They don't want to recognize that. I think that the issue is that what happens to China after when these guys are gone. It's okay. They were pumping money into property developers, and then they pump into local governments. And now a lot of local governments don't have money to spend. They just have to become smaller and smaller. The impact on ordinary people is limited.
So do you think the medicine that Beijing is dishing out, is that going to be enough to sort of revive the economy this year? No,
I think the economy will be kind of in a tough situation for many years. Last year, it grew by a little bit over 5%. And a lot of people think that this year is going to be better. I don't think so. I think that the reason is because last year we got a low base bounce in both domestic tourism and in automobile. And we're not going to see these two repeating performance. The export might improve a little bit because there was an inventory problem in the electronics sector last year. So, but I think 5% is going to be a struggle. China, the very low growth is not such a challenge anymore because the labor market, there's a structural labor shortage. The youth unemployment problem is related to all these college graduates who don't want blue-collar jobs. And so they have to figure out what they want to do with their lives. And the economy cannot provide so many white-collar jobs no matter what. If you created a bubble like in the internet sector or in the property sector, you might create some white-collar jobs, but they're not sustainable.
The government wants to put a lot of resources, doesn't it, into certain sectors that it sees as being a priority, like things like electric vehicles, solar panels, batteries, and the like. But is that going to be enough to sort of hold up the economy and also provide the jobs that are needed for all these unemployed youth?
Well, the issue is that the property sector deflating. The impact is is felt more immediately, and the local government is getting cut off, so they cannot spend like before. On the other side is that the resources are being reallocated to more competitive industries, like what he mentioned, the solar and EV, but it happens over time. So you cannot switch quickly, and the more the solution you could do a demand side solution more quickly by let's say tax cuts or some kind of payment to the household sector, like what happened in the United States. But Chinese government wouldn't do that because its priority is defined by this rivalry with the U.S. or the U.S. containment strategy. So it wants to pour resources into technology independence, and I think that's what they are doing. But it's not the demand impact is not enough to offset what's going on in the property sector.
And is this what President Xi Jinping means when he talks about high-quality development? That's the phrase he's used many times now, including in his New Year speech where he set out the economic goals for this year. Is that what he means by high-quality development?
I think high quality, one is national security trumps everything else. That's one layer of its meaning. The other is that the government will not bail out the property shadow banking sector. So because the government basically buckled every time when the bubble deflated, like in 2008 and a couple of times afterwards, because that the sector is so large, a lot of people over there inside have influence, especially shadow bankers. They have a lot of money. They don't have a whole lot of to do. So, and they have a big voice. And all these negative words you hear about in terms of government policy towards the property sector usually come from those guys. And they're still trying to get the government to do what it did in 2008. Or the U.S. government did in 2008, basically quantitative easing to bail these guys out. Basically, Xi Jinping is saying that it's not going to happen because his priority is really related to the United States. So you guys are not important anymore.
So what's going to happen at the end of the year? Because it sounds like you're not overly optimistic that things are going to improve in just 1 year. It's going to take longer than that. If the economy is still sluggish, is still struggling to get over the problems in the property sector, recover from the sort of economic measures that were going on during the pandemic, what next can the government do, or would it do?
No, I think the government will not do much. Basically, let it go.
Really?
So the economy is going to grow relatively slowly. But during the meantime, the resources are being reallocated to more competitive industries, and new activities are going to happen, including now it's becoming well known, the EV sector. China is going to become the dominant player in the global automobile sector. That's very important. Then we see solar, we see space, and new materials, and the semiconductor. All these sectors are going to rise over time. Well, the main impact, of course, there will be a growth impact. But in terms of macroeconomic impact, it will force the government to let the currency appreciate. So China will become high-income economy, not because of a really very fast growth, because of a currency appreciation, just like what happened in Japan, in Korea, in Taiwan. Ultimately, when you become high-income economy, because that you are so competitive that your currency has to become more like a rich country's currency, basically strong. So the currency value will go up.
But who's going to buy all these electric vehicles and that China produces? Because it doesn't have enough domestic demand to absorb that itself, all this overcapacity. And right now, the EU, the US are just not willing to absorb all that excess capacity and see their trade deficits with China surge even more.
Well, I think the EU is not in a good position, really. The EU is talking, but not doing anything. If they do something to Chinese companies, China surely will retaliate by doing something to European automakers in China, and they sell a whole lot more in China and make a whole lot of money. It's a European auto sector survival depends on the Chinese market. So I don't think that Europe is in a position to do much. I think the US will try to block Chinese EVs. The current 25% tariff probably will be increased at some point because the US auto sector is not viable. It hasn't been viable for a long, long time. But the US is only 15 million units. The global size is now 80 million. And Chinese EVs will become much cheaper over time. And also, a big advantage of EV is that its operating cost is very low. The fuel cost now it's 1 kilowatt hour goes 5 kilometers, and that range only goes up depending on how much the oil price is or what the electricity price is at where you are. The advantage is huge. In China now it's 5-1. And in Europe, it's less than that, but it's still a big advantage. In the United States, not much, not so much, because the oil prices, the gasoline price is low, and the electricity price is high. So it depends on where you are. But for emerging economies, the global South, they are going to be like China. The EV will have huge operating advantage. So as the price of an EV comes down, more and more people will be able to afford cars. So the whole market will grow above 100 million units before 2030. So Chinese companies could, by 2030, sell like 20 million cars outside of China, and the Chinese market is 30 million, will become largely Chinese. So eventually China will account for over half of the global auto sector.
Well, very interesting. Andy, great to talk to you. Thank you very much indeed once again, and have a great week and a happy new year. That's Shanghai-based independent economist Andy Scher.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Richard Harris, Chief Executive Officer at Port Shelter Investment Management, and our US economics correspondent, writer and broadcaster Barry Woods. See you tomorrow.
Money Talk